Hey guys, this is Tasha Green, realtor and investor with Go Green Realty Group. I am here collaborating with Cacy Matano with Austin Credit Care, and we are here to get you house ready. We're going to be doing weekly videos to give you education and tips on how to get you house ready. So today's topic, we're going to talk about mortgage qualifications. There is a lot of different factors that go into qualifying for a mortgage. One of the most important things is credit. So Cacy, you're a credit repair specialist. You do a great job serving my clients and clients all over the state of Texas. How do you get people's credit scores ready to qualify for a home?
Yeah, so it's a combination of a few, things, and we do it strategically. So when it comes to credit repair, and this is not just for my company, this is for anybody out there fixing your credit. The way it's done is it's a combination of removing negative items off your report, disputing them, getting them removed, and then also building a positive credit portfolio. So knowing, one, you need to know what you're trying to get approved for, what the qualifications are for it, and then what kind of credit portfolio you need. What are the lenders wanting to see on your credit report to make sure you qualify?
Okay. So what you're saying is that not only it doesn't matter just getting the negative off, you got to have some positive too.
Absolutely.
Okay.
We can, and that's one of the first things I tell every person who I have a consultation with is we can remove negative stuff all day long for you. If you are not ready to make payments on time and start building positive credit history, your score is not going to get, in the higher end of, credit.
That makes sense. Okay. So when someone comes to me, they're always like, Tasha, my credit's not good. I do a very in-depth consultation to make sure to see where you stand, give you next steps. And a lot of people just say, oh, Tasha, my credit's almost there, is that it? Not necessarily. So when you're trying to help people get their credit scores where they need to be, what is the typical score you try to get them at, or does that depend on the loan type they're trying to do?
Yeah, so, for me personally, I want to see everybody get, as high as I can possibly get them, because at the end of the day, no matter what, your interest rate is based on the higher you can get it, the lower your interest is going to be, regardless on, the type of loan. But as far as, there are some people who are in a situation where they need to get into home as soon as possible, and they're not able to wait till they have the highest credit score they can possibly get. And with situations like that, when they found a home and they want it, and it's a matter of I need to get from A to B to sign that contract, it's just getting them there. So if they're under an FHA or a government funded loan, we're going to get them, around a 600, 580 above there. If it's going to be a conventional or a larger loan, for, a bigger mortgage loan, we're going to get them, as close to a 700 and above as we can.
Okay, absolutely. So the higher the credit score, the actual lower the interest rate is, meaning you pay less money to the bank and we keep more money in your pocket. So that makes a good impact on a lower payment for your mortgage.
Basically, the banks they trust you more, so they're willing to, bring the price down a little bit.
All right. So another thing that, a lot of people ask about, we got the credit thing situated. We understand that. But another thing is income. That's one of the other qualifications when it comes to buying a home. The more income that you make, the more home you can qualify for. But we also have to tie in your debts. And a lot of lenders will spit out the acronym DTI. And what DTI is debt to income ratio. What that is, they take a calculation. It's a calculation of your income with your debts, and it spits out a percentage to let the lender know how much home you can actually qualify for.
Right. And most lenders are looking to see under 40%. Anything under 43%, but you really want it under 40%. When it comes to your debt to income ratio. So like you said, income matters. One, you have to have enough income to pay your mortgage, right? But you also have to have enough income to pay all the other things that you've already signed up to pay that they can see. And they can see your other things on your credit report as well, even though it's not necessarily your credit score. So there's an item that, lenders will see on your credit report that still shows you're paying this amount towards your debts every month, for all of these accounts. And what they're trying to see is that, what do you have left over after, the stuff you're already obligated to pay, everything you've already, signed up for? What do you have left over for that mortgage loan? So that's your debt to income ratio. How much of your money is already tied up every month, towards other obligations?
Absolutely. Okay. So basically what that means is you can make a great amount of money, but if you're tied down to a lot of debt, it could really affect how much home that you could qualify for. It could also make the difference of, you may not be able to afford the $350,000 home. You may have to go down to $275,000 based on committed debts that you're already obligated to. So this is a quick tip. I get this question all the time. So, hey, Tasha, Cacy, my credit's good, my income's good. I want to buy a new car. I got a car, it works. But I want that new. I want that 2021. But then I also want to buy a house. What do you tell your client?
Wait. Or pick, it's what do you want? What do you want first? Because you're not going to get them both right away. If you're going to try and sign a mortgage, you do not want to show up with a brand new car amount of 21 debt on your credit report. You're going to want to wait and secure your home before, banks are going to see that you have that substantial amount of debt. And when it comes to qualifying for an auto loan versus qualifying for a mortgage loan, those are different. Your debt to income ratio does not matter as much with the auto loan as it does with a mortgage loan, especially if you're asking for money from the government for your mortgage loan. You're not going to want to be showing that amount of debt.
And I'm so glad that you pointed that out, because that is very important. I think a lot of people don't understand that, and that's why we're here. That's why we're doing this for you, is because it is a way big difference trying to qualify for a car as opposed to qualifying for a home. It's way more intensive than that. Absolutely. All right. So another thing is that ties into income is your job history. You want to have consistent job history up to 2 years. Lenders look at that. Do you run into clients that have situations where their credit was impacted by their job history? Maybe
Absolutely.
COVID?
Okay. Yeah, both. Where their jobs are also impacted by their credit as well. There are jobs out there, they run your credit. And routinely while you're working for them, if something comes up, I've had clients come to me where they were flagged for something with their work. So, when it comes to job history, you're going to be able to see your job history on your credit report. When a lender pulls your credit, they can see a few past jobs. So that's something you can control. You can control what is shown on your credit report. If you have outdated history on your credit report, you can have that removed. So that way your most recent history shows, and what is needed for the lender is there. There's not too much extra. And you're not gonna want to show jumping from job to job. Lenders, especially when it comes to a mortgage loan, you're asking for a lot of money, so you're not going to want to have you want to show stability, that you have your income is stable and you can make those payments on time.
Absolutely. Yeah, it's a big risk when a lender is giving you that kind of money. So when it comes to job history, a couple of things I want to point out. I don't want people to feel, well, I didn't have, consistent job history for 2 years because I just had a baby. Those things that are explainable, you took FMLA because you had a baby, but you still got paid. That's understandable. That's something that we can explain and back up to a lender. So those are examples that you don't have to necessarily feel that, oh my gosh, if I haven't worked 2 years straight, I can't get a home. Or you moved.
Yeah, there's still real people on the other end of the line. The lenders are real people. They do understand life situations and circumstances. However, just taking a break from being employed or having a gap of job history and not having that explanation is where the problem comes in.
Absolutely. So a couple of things that I want to talk about, and this is something where we can both benefit you and help you, is some of the red flags that people don't understand that impact them from their ability to qualify for a mortgage. And these are some of the things that I screen for to help you and guide you on how you can qualify for a mortgage. And this is definitely services that Cacy can help you with.
Absolutely.
One of the things that come up as a red flag, let's say, for example, your credit score is not bad. Got a 620, income's looking all right, but we have student loans. Mm-hmm. I just want to stress, student loans are a big deal. No, they don't go away, unfortunately. But think about it. If you're trying to qualify for a federally backed loan, these are federal student loans. A lot of people's loans go in default. A lot of people, are not making payments, not making arrangements. So if you do not have your student loans in a good active status, it will affect your ability to qualify for a home. So Cacy, how can you help a client that is behind on their student loans or it's reporting negatively?
Yes, absolutely. So this happens. A lot of people get in that situation, and they're absolutely what you just talked about. They get into a lender's office and they have that perfect credit score, and they get told no because they have a student loan that's gone into default. So when you have a student loans, you actually have a couple of options to get your student loan out of default. If you're wanting to buy a home, the option I recommend is doing a rehab program, because when you do a rehabilitation program on a student loan, once you've completed the program, the past history of the default and of the delinquency of the account is no longer visible to the lender.
Wow.
So it gets wiped away. So a rehabilitation of a student loan is where basically you provide your tax statements to who your student loan is with, to Federal Department of Education, and they're going to, based on your taxes, set you up on a payment plan for 9 consistent payments. If you're able to make those 9 payments on time, and they're normally very, very affordable. This is based off your income. So this is not like your regular student loan payments. These are anywhere payments from $5 to $100,
Wow.
depending on your financial situation. So you make those 9 payments on time, everything that's negative on that account gets wiped and it goes back into good standing. And at that point, it's helping your credit. It's actually going to help you build credit, and it looks good. Banks can see that, like, hey, you took out a substantial loan, you went to school, and you're paying it back on time. So that's a way to actually, people get hit with that red flag of their student loans, and that's a way to just completely reverse that situation and actually bring it back to the lender and say, hey, like, this is helping me now. Your score even goes up normally when you get it back in a positive stance.
Awesome. So for those that may have some trouble with student loans, we're here to tell you there's hope for you.
Yes.
All right. What about broken leases?
Yes. So with broken leases, it's going to be a negative mark on your credit report, and it's if the account is there and it's showing, you need to handle it, settle it, or get it removed off your credit report. And it really depends on where the account is, on what I would recommend somebody does with it in your situation. But it's important things to know: statutes of limitations. How long ago did it happen? Has it already been turned over to a collection agency? If it is already turned over to a collection agency, you need to handle it differently. Versus if it's something that just happened, you may be able to actually remedy it before it goes, really delinquent on your credit report. So I would say, number one, find out if you have a broken lease on your credit report, or you have a broken lease and you want to buy a home. You need to find out where you stand. You need to get your credit reports and see that broken lease and see what is the status on it, how delinquent is it, what are they reporting and who's reporting it, has it been turned over. Find out where you stand.
Absolutely.
Yeah.
And so the impact with a lender, how they look at that and they won't qualify for you for a home, is the fact that, we as Americans, we prioritize having shelter. And so they will look at that as, no matter what the situation is, if it's not something that can be explained, maybe it's like a court situation, if you don't have documentation to support what happened, if it's not explainable, then it looks like that, you're not prioritizing finances, and they're not going to feel comfortable to lend you that high amount of money for a mortgage. What about a repossession?
So, it's going to be the same thing. Repossession is where, obviously you asked for a loan for, either a car, a home, something, and it got repossessed. They had to take it back from you because you weren't able to make those payments. So it's going to be a negative thing on your credit report. If you have something that's been repossessed, you need to pull it. You need to see if it's on your credit report, if it's there, how long it's been since the delinquency. Basically, since you stopped making payments, how long has it been, and does the original person still have it? So you need to get it taken off your credit report no matter what. And it's just how you go about handling it, either disputing it and having it removed, or, settling with the creditor if it's been recent.
Okay. All right. And then what about child support, back child support?
Right. So with child support, there are laws that go around what can be reported as child support. So, of course, find out what's being reported, and then when it comes to child support, you need to contact who your agreement is with. Normally, if your child support agreement is with the OAG, you need to contact the OAG and you need to say, hey, this is affecting my credit. What can I do to have it report positively on me or get it taken off my credit report? And they are more than willing, if you are willing to make some sort of payment or work with them and get set up on something, they will take it off so that it's no longer reporting.
Okay. Now, what about the instance where child support has already gone to a collection agency? I've seen that a couple of times.
It can still go back. So if it's with the collection agency, you can dispute it if it's already been turned over.
Okay.
Generally, that's rare that it gets turned over, but you can always request that it goes back to the OAG, back with who you made that contract with, and to start making your payments again and get it, just the status of it turned over. It's not necessarily like, oh, I owe this much in child support and I have to get it, like, that balance removed. You don't have to have the balance gone. You just need the status changed.
Okay.
You need it to be a positive account if it's going to be reporting.
Okay. And then a lot of times, some people were young when they started. They're 18. They got bank accounts. They didn't take care of them. They got bank-issued credit cards, bank-issued loans, and now they're reporting negatively on the credit report. How can you help them with that?
Yeah, we need to get them taken off. If they're old, it's stuff you did when you were young and it's still showing up. You need to get it taken off. Call me, look into credit repair, figure out where your account falls under the FCRA laws, under the statutes of limitations, so that way you know what your best option is with that account. Dispute it yourself, have somebody help you dispute it so that way it can get taken off your credit report. If it is something that is super recent and you have the chance to remedy it and have them reactivate the account or make it positive, and you have the financial means to do so, absolutely do it. Otherwise, if it's old, it's from when you're young, it wasn't, anytime soon, just get it off. Get it taken off your credit report.
Absolutely. So with that, it's a bank that's going to give you a loan. So if you're not able to take care of your finances with small amounts with a bank institution, then a lender's not going to want to qualify you for a mortgage loan. It looks risky. One of the last things that I want to talk about that people don't realize how in depth lenders look at your financial situation. They request 2 months of your past bank statements. They look at your transactions. So what's really important, one of the things people don't know, Cacy, is that they look at your cash flow. They look to see what comes into your checking account, what goes out. And what they're looking for is insufficient fund charges. So if you have a recent history of a bunch of insufficient fund charges, we recommend on my stand side to wait a few months and kind of clean that up, because it'll look like with the lender, it'll look like a cash flow problem. So they'll say, well, if you can't manage your checking account, you can't manage your funds, how can you manage to pay this mortgage?
Right. So even if you have the great income, if you show up with the red flags of the insufficient funds, it can still disqualify you. So basically, if you're getting ready to buy a home, you need to really be on top of your financials in your bank account and make sure that doesn't show up under your bank account.
Absolutely. And so reason that we're doing these videos, a lot of us are not educated. That's why we feel the need to bring you these tips and bring you this education. But the past is the past. We're here to help you move forward and provide you any education. We'll provide any answers to questions that you have. Subscribe to this video below if you have comments. If you have questions more specific to your situation, we are here to help. You can get in contact with us. This is Tasha Green, Realtor with Go Green Realty Group.
And Cacy Matano with Austin Credit Care. We'll see you guys next time.
Bye.